committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. Without objection, members of the full committee not on this subcommittee are authorized to participate in today's hearing. This hearing is entitled the Community Reinvestment Act, Assessing the Law's Impact on Discrimination and Redlining. And I now will recognize myself for 5 minutes to give an opening statement. To Ranking Member Lukamaya, members of the subcommittee, welcome to this hearing on modernizing the Community Reinvestment Act. The work of our subcommittee is critical because we consider the complexities of an evolving banking sector enabled by rapid developments in technology and critically important issues of consumer protection. Today's hearing is an example of these opportunities and challenges and the importance of not losing sight of our obligations to American families, small businesses, and the least fortunate among us. The Community Reinvestment Act was enacted into law in 1977 as a direct response to the long, painful legacy of structural discrimination, financial exclusion, and economic suppression of racial minorities in America. Banking, finance, housing, and access to capital more broadly are key pillars to the opportunity in breaking cycles of poverty and exclusion. I come from a family of very humble means. My parents' access to financing to purchase a home was among the most important circumstances that laid a path for me to go to college, become an attorney, and ultimately to serve as a member of Congress. My siblings' lives were equally impacted by my parents' ability to build equity and allow us to grow up in a home. Conversely, I have family relatives who were deprived of this opportunity and whose children and grandchildren's lives have equally been impacted in a negative form. We could not downplay the legacy of redlining, structural discrimination, and in the financial sector, and how it impacts echoes through time to this very day. We will hear in the testimony of the witnesses here today how the CRA has contributed to redressing some level of discrimination in access to banking services and lending, including specifically mortgage lending. But we will also hear how shocking patterns of discrimination persist, how racial minorities continue to find themselves disproportionately denied mortgages and the chance at home ownership. Sadly, we will also hear how brutal a combination of disproportionate impacts from the financial crisis combined with a retrenchment of bank branches have effectively erased nearly all the gains in black home ownership over the past 50 years and led to a situation where the gap between black and white home ownership and black wealth are at levels comparable to the pre-civil rights era. I repeat, we must do better. I look forward to hearing from our witnesses their thoughts on effective ways to modernize CRA, to address these issues, consideration of fintech, the rapid increase in urban and rural banking deserts, and the importance of non-bank lenders who are not covered by the CRA. Ultimately, I believe that we are interested in ensuring that banks and lenders continue to meet their obligations to the unbanked and underbanked, and that evolving business models and emerging technologies do not lead to increased exclusion or new patterns of discrimination. The CRA undoubtedly needs to be modernized, and last year the OCC put forward an ANPR which laid out some important questions for discussion, but also raised some red flags for advocates of CRA. My office submitted a comment letter, which I am entering into the record here, raising some concerns and calling on the OCC to protect the integrity of the CRA. The OCC revived some 1,500 comment letters, and it was rewarding to see that the idea of protecting the integrity of the CRA was a common thread through most, alongside many good ideas for consideration with respect to assessment areas, transparency, accountability, a focus on impact, and others. It has also been very helpful for the Federal Reserve to weigh in, including specifically Governor Brainard, whose comments on CRA modernization have been thoughtful and offer a constructive framework for tackling complex issues. In private meetings, and now here on record, I urge the OCC, the FDIC, and the Fed to work in concert on CRA modernization in good faith to take a thoughtful, inclusive approach and to consider carefully the original intent of the legislation. I was very encouraged to hear that the OCC and the FDIC and Federal Reserve have been working to harmonize their CRA review process and will meet on April the 11th, 2 days from now, to begin mapping out a notice of proposed rulemaking. I very much look forward to discussing these issues further today with the panel of witnesses and members of the subcommittee. With that, I now recognize the ranking member, Lukamaya, for his opening statement.
Thank you, Mr. Chairman, and thank you for bringing this important issue and topic in front of the committee. I'm glad we are having this hearing today to discuss how banks meet the credit needs of their local communities. Throughout my career in the financial services industry and my time in Congress, I've championed access to credit for all individuals and businesses. Banks should not decide to make loans based on the gender or race of an individual and should not deny loans to individuals based on the neighborhood they live in. Similarly, banks should not be forced to deny loans and eliminate accounts of legal operating businesses simply because certain regulators or public officials do not like the industry in which they operate. It is the role of banks to take into account creditworthiness to determine if an individual business is eligible for access to financial services. While the vast majority of banks work very hard to support and serve their communities, the truth remains that too many Americans are either unbanked or underbanked. Enacted in 1977 to address the banking needs of underserved communities, the Community Reinvestment Act was well intended, and the original objective was noble. It sought to combat redlining, the practice where individuals were discriminated against based on where they lived and what their neighborhood looked like. Unfortunately, the CRA as it exists today is very different. Over 40 years later, the CRA has proven to be an overly burdensome requirement for financial institutions while granting broad authority to regulators with little transparency and clarity on how to comply. Although the CRA has been amended numerous times since 1977, many of the rules associated with CRA are not only from the pre-cell phone era, but they are from the pre-internet era. Since 1977, the banking industry has gone through a major evolutionary shift thanks to constantly changing technology. We now see fintech companies popping up everywhere, looking to meet the challenging credit needs of American consumers. Local bank branches are seeing shorter lines as consumers turn to online banking. In fact, everyone in this room should go online right now and could go online right now and do nearly all their banking without leaving their seat. As banks partner with and acquire these fintech companies, changing the way they serve their customers, so must the CRA change the way it applies to banks. In reassessing the CRA, banks should be aware of the specific requirements they must meet. For example, a CRA requires regulators to examine the innovativeness banks use to service groups of individuals they previously did not. However, no formal definition of innovativeness has been established, leaving banks to face a subjective process. Across the nation, bankers want clarity on how to comply with CRA and better serve low and moderate income individuals in their communities. In order to solve the many issues with CRA over the last year, federal financial regulators have begun the process of utilizing their authority to bring the CRA into the 21st century and align it with the realities of the banking industry today. I believe this is the correct approach, and regulators should continue their work to fix this outdated regulation. These changes are well overdue, and I look forward to the discussion with the panel today to determine what is not working with CRA as it exists today and what changes must be made going forward. I thank the panel of witnesses for appearing this morning to discuss this important matter, and I yield back.
The gentleman yields back. And without objection, I authorize the chairwoman of the full committee is recognized for 2 minutes, and I also will give the ranking member side an additional 2 minutes should they want it. I now recognize the chairwoman.
Thank you very much, Mr. Chairman. I thank you for holding this long overdue hearing on the Community Reinvestment Act, a law of immense importance that was put in place to ensure fair access to credit and banking services. CRA is one of the most important and impactful civil rights laws applicable to federally insured banks. Enacted into law by Congress in 1977, CRA addresses how banks meet the credit and capital needs of the communities they serve. CRA was passed in response to redlining, a pernicious practice by which banks discriminated against prospective customers based primarily on their racial or ethnic background and where they live rather than credit worthiness. However, recent data compiled by one of our witnesses finds discrimination in lending continues to be a problem, and redlining continues to be pervasive in more than 60 metro areas across the country. In addition, in 2018, bank regulators gave 98% of banks a passing CRA grade. There's a clear disconnect, and these outcomes are simply unacceptable. CRA must be strengthened to ensure neglected communities are fully and fairly served by banks that enjoy the backing of all U.S. taxpayers. Furthermore, policymakers should strive to strengthen CRA's legal framework and explore ways to improve how it is implemented and administered. Mr. Chairman, I think that the leadership that you and others are providing on this issue at this time is extremely important. The day is over when banks are going to get credit for a church banquet and a banner on the wall that gets CRA credit. The day is over when it's 50 cents to the Boy Scouts and 25 cents to the Girl Scouts. It's got to be better. It's got to be about doing what this law intended it to do. So I thank you for today's hearing, and I yield back the balance of my time.
Yield 2 minutes to...
Well, I thank the chairman. Chairman Meeks, thank you for holding this hearing. Thank you, Ranking Member Lukemeyer. In 1977, the Community Reinvestment Act was passed. This was 6 years before the first mobile phone became available to the public. And while the objectives of CRA are not a relic, the means to reach it are, in fact, antiquated in our current marketplace. Today, the CRA is an analog approach to a digital world. 95% of Americans own a cell phone. So you can no longer measure a bank's commitment to its community based on the number of physical branches. So we can and we should do better. This should be a bipartisan understanding that we have. So we should do more to ensure that there is equal access to consumer credit. There are, in fact, banking deserts in this country, both urban and rural. So while the goal of the CRA is laudable, the results aren't quite as sterling as we need them to be. So we need to update this regulation, update the law, in fact, if we're able, to ensure that banking is available to people on their terms through the medium they choose. It's time to reform CRA, not to allow financial institutions a free pass, but to ensure they are in the best possible position to serve their communities, serving their communities as those communities deserve to be served by the means that they deserve to be served, like all good consumers. So I hope we can work on this in a bipartisan fashion. I appreciate the panel, 6 of you, for being here, and look forward to the testimony.
Thank you. We now welcome the testimony of our guest. First, let me introduce Mr. Van Tol, who is the Chief Executive Officer of the National Community Reinvestment Coalition. Mr. Van Tol has been with the NCRC since 2006 and has held a variety of leadership positions. His work championing fair and responsible banking has resulted in nearly $90 billion in new investments in low and moderate income communities through community benefits agreements with 8 banking institutions. He serves on the board of the Maryland Consumer Rights Coalition and the Executive Committee of the Americas for Financial Reform. He also sits on a variety of advisory boards, including the Federal Reserve Board's Consumer Advisory Council and Fannie Mae and Freddie Mac's Affordable Housing Advisory Councils. He's a member of the Consumer Advisory Councils of several banks, including Bank of America, Fifth Third, and others. Mr. Van Tol received his BA in History and International Studies from the University of Wisconsin-Madison. Second is Ms. Baradadan. She's the Associate Dean of Strategic Initiatives and Robert Cotton Austin Chair in Corporate Law, the University of Georgia School of Law. As an Associate Dean, she focuses on diversity and inclusion efforts and national and international faculty scholarships recognitions. Her teaching portfolio includes contracts and banking law, She's the author of books on How the Other Half Banks and The Color of Money, Black Banks and the Racial Wealth Gap, both published by the Harvard University Press. She also has published articles including Banking and Social Contract, How the Poor Got Cut Out of Banking, and the New Deal with Black America, which was selected for presentation in the 2017 Stanford, Harvard, Yale Junior Faculty Forum. She came to the UGA from Brigham Young University, where she taught banking regulation, property, and administrative law. She earned her bachelor's degree cum laude from Brigham Young University and her law degree cum laude from NYU, where she has served as a member of the New York University Law Review. Next, we have Mr. Odom, Senior Vice President, Policy and Advocacy and Washington Bureau Executive Director of the National Urban League. Mr. Odom currently serves as the National Urban League's Senior Vice President for Policy and Advocacy and Executive Director of the Washington Bureau. Mr. Odom previously served for a decade in the United States Senate as Legislative Director for Senator Kamala D. Harris of California, Democratic General Counsel of the Committee on Commerce, Science and Transportation, and General Counsel to Senator Bill Nelson of Florida. He also served as a senior advisor at the Federal Communications Commission and practiced law at the law firm of Doe, Lowndes, and Alberston, now Cooley LLP. He served as a law clerk to the Honorable Henry T. Wingate of the U.S. District Court of the Southern District of Mississippi, and is a graduate of Louisiana State University and the University of Pennsylvania Law School. Our next witness will be Mr. Mitchell. Mr. Mitchell is the president and CEO of Industrial Bank, a representative of the National Bankers Association. Mr. Mitchell leads the largest minority-owned commercial bank in the Washington metropolitan area and the 5th largest African-American-owned financial institution in the country. Mr. Mitchell is the 3rd generation president of Industrial Bank, which was founded by his grandfather, Jesse H. Mitchell, in 1934. After receiving his bachelor's degree in economics from Rutgers University in 1984, he began a full-time career at Industrial Bank. He was elected to the board of directors in 1990 and succeeded his father as president in 1993. Mr. Mitchell is the immediate past chairman of the National Bankers Association, which represents the nation's minority banks. He served 2 consecutive terms as chairman of the NBA and continues to serve on the board. At the request of the chairman-elect, Preston Kennedy of the Independent Community Bankers of America, Mr. Mitchell now serves on the ICBA 2019-2020 Legislative Issues Committee. He's also a former member of the ICBA Safety and Soundness Committee. Next is Mr. Glantz, Senior Reporter, Reval from the Center of Investigating Reporter. Mr. Glantz is a senior reporter for Reval from the Center of Investigative Reporting and author of the book Home Wreckers, to be published by HarperCollins this fall. He produces journalism with impact. His work has sparked more than a dozen congressional hearings, the signing of new laws and criminal probes by the DEA, the FBI, Pentagon, and Federal Trade Commission. His reporting has been honored with a host of awards, including the George Foster Peabody Award, the Selden Ring, and DuPont Columbia Award. His work has appeared in many leading media platforms, including the New York Times, NBC Nightly News, Good Morning America, and the PBS NewsHour, where he has twice been nominated for a National Emmy Award. A recent JSK Fellow at Stanford University, his previous books include The War Came Home, Washington's Battle Against America's Veterans, and How America Lost Iraq. And finally, we have Mr. Roberts, President and CEO of the National Association of Affordable Housing Lenders. Mr. Roberts is President and CEO of the National Association, and NAAHL is the National Alliance of Leading Banks, Community Development Financial Institutions, and other capital providers for affordable housing and inclusive neighborhood revitalization. Mr. Roberts was the director of the Office of Small Business Community Development and Housing Policy at the U.S. Treasury Department from 2011 to 2015. He was previously Senior Vice President for Policy and Program Development at the Local Initiative Support Corporation, a leading nonprofit investor in low-income community development. Mr. Roberts has helped to create the Low-Income Housing Tax Credit, the New Markets Tax Credit, the Home Housing Partnership Program, regulatory changes to the Community Reinvestment Act, the Capital Magnet Fund, Treasury funding for the FHA multifamily risk-sharing loans to finance affordable rental housing, and bond guarantees for the CDFIs. And we welcome all of our witnesses today. And I want to remind all the witnesses that your oral testimony will be limited to 5 minutes, and without objection, your written statement will be made part of the record. And I now recognize Mr. Van Tol for 5 minutes to give your oral presentation.
Chairman Meeks, Ranking Member Lookemeyer, and members of the subcommittee, I want to thank you for providing me the opportunity to testify. I am the CEO of the National Community Reinvestment Coalition, which, along with its 600 grassroots member organizations nationwide, champions fairness and fights discrimination in banking, housing, and in business. I want to start by saying that CRA has been effective. Federal, academic, and NCRC's own studies have documented the way CRA has increased the provision of mortgage loans, small business loans, investments, and other financial services in low and moderate income neighborhoods and to low and moderate income people. But measuring CRA's impact involves proving a counterfactual, what would happen if it didn't exist. The Federal Reserve Bank of Philadelphia found that a loss of CRA census tract designation leads to a 10 to 20% decrease in mortgage lending, and we see a similar thing with small business lending. Conservatively, we estimate a $52 to $105 billion loss or shift in lending in LMI areas nationwide were CRA to be significantly weakened or assessment areas transformed. All told, banks have done over $1 trillion in community development lending since 1996. The impact is not just by the largest banks. Even intermediate small banks finance about $3 billion annually in community development projects, or about the same amount of annual funding as the Community Development Block Grant Program in its entirety. Though CRA could do more for rural America, we also see a positive impact there. For example, in Appalachia, we found that CRA-regulated lenders made nearly $2.5 billion annually in community development loans and investments. But CRA has been limited by changes in the market. CRA's overall impact has declined as the share of loans covered by CRA has declined. In 1993, 41% of mortgage loans were directly covered by CRA review. By 2016, only roughly 30% of mortgages were covered. There are two driving forces here: increased lending by non-banks and more out-of-assessment area lending by CRA-regulated banks. This trend is likely to continue and will be exacerbated by the growth of financial technology firms with no CRA obligation. The fact that regulators are examining less and less bank lending on CRA exams limits its impact to only a portion of the market. Most non-bank lenders trail CRA-regulated banks in lending to LMI borrowers and tracts. In addition, non-bank lending is consistently more likely to be high cost than bank lending. For example, government-insured loans to LMI borrowers by non-banks were higher cost twice as often as loans to the same borrowers made by banks. Weak enforcement and implementation has stymied the law. As effective as CRA has been, as currently structured and enforced, it has not been enough to reverse the effects of redlining and discrimination. 98% of banks receive passing CRA grades. It hasn't always been this way. The Clinton administration rigorously enforced CRA, failing as many as 10% of banks at one point. Then Comptroller Eugene Ludwig noted in 1997, since 1993, home mortgage loans to low and moderate income census tracts have risen by 33% in just 4 years. Mortgage loans to minorities are up almost 38%, with African Americans and Hispanics accounting for most of that gain. CRA enforcement has often been encouraged by community activism and by DOJ litigation, then leading to regulatory action. The differences between the tenure of Comptroller Curry and Comptroller Otting are also worth noting. Comptroller Curry downgraded CRA ratings for several banks for fair lending violations and placed conditions on bank mergers. In contrast, his OCC successors issued guidances weakening CRA enforcement, including imposing limits on downgrades for fair lending violations and speeding up mergers. Not only has the OCC stepped away from conditional merger approvals, but it is also approving them more quickly. CRA regulatory reform must be consistent with the law and the legislative history. All three regulators have weighed into the discussion over CRA regulatory reform with differing approaches. The The OCC has suggested a transformational approach to reform, with some ideas that would weaken CRA significantly. Voices across the spectrum have impugned the OCC's notion of a single metric, or one ratio, that could overly weight a rigid quantitative analysis by regulators and facilitate more CRA grade inflation. The approach would undermine the qualitative local analysis, which is critical to CRA, that is designed to assess whether banks are meeting credit needs in all communities and in the neighborhoods they are chartered to serve. I look forward to making additional recommendations on ways to strengthen the Community Reinvestment Act in the Q&A section. Thank you.
Mr. Redlining.
Chairman Meeks, Ranking Member Lukemeyer, and Chairwoman Maxine Waters, thank you very much for having me here. In passing the CRA in 1977, Senator William Proxmire stated that the act was based on the widely shared assumption that a bank's public charter conveys numerous economic benefits, and therefore it is fair for the public to ask something in return. The underlying theory of the CRA is that banks have duties to the public because they benefit from significant government subsidies. This bank-government social contract seems to have been forgotten entirely. Banks enjoy a monopoly on the Federal Reserve payment system, receive subsidized funding through FDIC-insured deposits, make loans supported by federal guarantees, and invest in mortgage-backed securities markets enabled by GSEs. And all of this still doesn't cover the bailouts when the industry fails, or the unprecedented monetary policy actions of the Federal Reserve, including trillions in quantitative easing. Banks need this support, without which their customers would lack sufficient trust to permit them to function properly. For trust is the currency of banks. In return, banks are to serve as the engines at the center of the economy. They provide credit, financial services, and liquidity. It is their role to connect the people to commercial markets and administer government credit policy and monetary policy. For most of U.S. history, banks were forced to stay local, small, and safe, so that they would meet the needs of their communities. Yet, during the deregulatory era that started right after the CRA was passed and seems to still be ongoing, these restrictions were eroded. Wave after wave of deregulatory legislation completely transformed the banking sector to one that is large, complex, laden with risks, very profitable, and highly competitive. Small community banks have struggled to survive this hyper-competitive environment. As banks grew larger through mergers and became more efficient, they dropped their unprofitable branches and their unprofitable customers. Banks also shed their public duties. All of this deregulation happened slowly and promised more efficiency. But at the end of the day, the government was left holding the bag. Because banks operate using, in the words of Louis Brandeis, other people's money. They're not like other businesses. Congress and regulators, therefore, must be watchful that reforms promising modernization and efficiency do not become a Trojan horse, hiding even more deregulation, relieving banks of their last remaining public duties. Of course, the CRA should be updated and compliance should be transparent. But when regulators promise changes that have ease of compliance or efficiency, we must step back and ask a few questions. Efficient for whom? Why should efficiency be our primary concern? More importantly, what kind of banking sector would best meet the needs of the public, and how can we design laws to achieve that outcome? We need a banking system that provides equal access to credit and services for all. The problems that the CRA was meant to address have not been solved, and we must remember that these problems that we're talking about are not just numbers. Poverty, exclusion, predatory lending, segregation, and an intergenerational racial wealth gap affect human lives and real communities. These are the communities that we're talking about when we're talking about CRA duties. Low-cost bank accounts and credit products are not a cure to poverty, but they do help. These problems are too large and too complex and too entrenched for one law or one industry to solve. Yet, the democratization of banking is necessary. It's still, I think, too important a public imperative to be left solely to the private sector. If we're serious about financial inclusion, it's time that we consider a public option. Insofar as the states enable credit markets, deposit accounts, and payment systems, all Americans should have equal access to these public utilities. But short of that, banks have public duties because they benefit from significant public support. The CRA is the only law that places affirmative duties on banks. Most major banking laws have some sort of public benefit test. In other words, before a bank is supposed to merge or add any other activity, all the laws, the Bank Holding Company Act, the National Bank Act, all of these laws require that the regulators ask, what is the benefit to the public? In other words, when a bank merges, will communities lose branches? Today, the CRA is meant to encapsulate the entirety of this public benefit test. In recent years, bank mergers have only increased, as has disinvestment from LMI communities. The Fed just set 2 records last year, the highest ever approval rates for M&A proposals, and the quickest ever time to approval, especially for mergers that received adverse comments from the public. The only question asked was whether the bank was in compliance with the CRA. That's not enough. A strong CRA should be one step in an effort to match the large inequalities in the credit system, the conglomeration of the banking sector, and the historic injustice of the racial wealth gap. Thank you.
Recognized for 5 minutes.
Good morning, Chairman Meeks, Ranking Member Lukemeyer, and Chairwoman Waters. Thank you for the opportunity to present the National Urban League's views on the Community Reinvestment Act. My name is Clint Odom, the National Urban League Senior VP of Policy and Director of its historic Washington Bureau. Established in 1910, the National Urban League is the nation's oldest and largest civil rights and direct services organization. Each year, we serve 2 million people through 90 affiliates in 36 states and the District of Columbia. Our views and recommendations are based on decades of direct experience in urban communities across the country and our historic role in documenting and fashioning remedies to root out the pernicious practice of redlining. Congress passed the CRA because of concerns that federally insured banking institutions were not making enough credit available in the communities they served. Disinvestment practices allowed depository institutions to accept deposits from African Americans in the inner city, but reinvest them in more affluent suburban areas. Faced with substantial evidence of redlining, Congress decided that market forces alone could not break down residential segregation patterns. Thus, the CRA was enacted, and we'll hear a lot of this today, quote, to reaffirm the obligation of federally chartered or insured financial institutions to serve the convenience and needs of their service areas and to help meet the credit needs of the localities in which they are, consistent with the prudent operation of the institution. Redlining prevented African American and other communities from securing affordable homes and mortgages in decent neighborhoods and purposely segregated communities. Segregated into slums, African Americans were concentrated into poverty by way of intentional discriminatory policies. They were denied credit to purchase homes, start small businesses, and to meet everyday living expenses. Blight, crime, and decreased property values often ensued. Cities were left behind with no adequate tax base for basic services. With no desire to invest in these communities, many African American communities continue to deteriorate today, as you will hear from other panelists. To be clear, the CRA is one of the most important civil rights and economic justice laws of the 20th century. In the 21st century, however, the law is in dire need of reform to better serve low to moderate income communities. CRA-regulated institutions have not always met the needs of their communities, allowing an array of non-banks to enter the marketplace, many of which provide high-cost and often predatory products. Both advocates and industry agree. The CRA can and must do more. My submitted testimony offers several reform suggestions for the committee's consideration. I will highlight 3 here. First, modernizing the CRA service test to measure how well banks are serving low to moderate income communities. The service test must do more to incentivize banks to offer credit products. There is a problem when 98% of CRA-regulated institutions get a satisfactory or outstanding rating. 2, developing regulations to encourage majority institutions to invest in minority-owned institutions. We agree with the American Bankers Association that, quote, minority-owned institutions were pioneers in helping underserved neighborhoods before the CRA existed, and their perseverance in serving those markets has made them worthy partners in leading further efforts to build stronger, more economically vibrant communities. It is past time for the agencies to adopt regulations that recognize and thereby encourage investments in and support of minority institutions by majority institutions, something that Congress authorized years ago, but still has not implemented in the CRA process. Third, including non-banks under CRA regulation. Non-banks have taken on the responsibility of serving LMI communities. The only place banks have a stronghold in LMI lending is their assessment areas. Including non-banks under CRA's purview would help ensure LMI communities' needs are met while limiting access to excessive risk-based pricing. Immediately following the Civil War, Congress enacted the Civil Rights Act of 1866, which states that every citizen of the United States, including former slaves, had the right to inherit, purchase, sell, hold, or convey property, both real and personal. As a nation, we've been struggling ever since to get this right. The CRA is as relevant today as it was in 1977, and we urge Congress through its oversight powers to do more to access affordable credit and quality investments in communities of color. Thank you.
Thank you. Mr. Mitchell, you're now recognized for 5 minutes.
Good morning, Chairman Meeks, Ranking Member Lukemeyer, Chairwoman Waters, and members of the subcommittee. Thank you for this opportunity to allowing me to testify on the Community Reinvestment Act. It gives me great hope that one of this committee's first hearings of the 116th Congress is shining light on this critical issue. My name is B. Doyle Mitchell, Jr., and I'm President and CEO of Industrial Bank. Industrial Bank has been serving individual customers and small businesses in Washington, D.C. and Prince George's County, Maryland, since 1934. I'm also on the board of the National Bankers Association. The NBA is a leading trade association for the country's minority depository institutions, or MDIs. Our mission is to serve as an advocate for the nation's MDIs on all legislative and regulatory matters concerning and affecting our member institutions, as well as the communities that we serve. Many of our member institutions are also community development financial institutions, CDFIs, and many of our member institutions have become banks of last resort for consumers and businesses who are underserved by traditional banks and financial service providers. The National Bankers Association support a strong CRA. In enacting CRA, Congress stated that the purpose of the CRA was to ensure that regulated financial institutions demonstrate that they serve the convenience and needs of the communities in which they are chartered to do business. As such, these institutions have a continuing and affirmative obligation to help meet the credit needs of local communities in which they are chartered. While the CRA has made great strides in ensuring access to credit in low and moderate income communities and among minority and low income borrowers, systemic economic and social challenges remain, perpetuating a lack of access to fair credit services for many and allowing predatory providers to thrive. Given growing economic inequity in urban, rural, and Native American communities, it is important to get CRA right. We strongly support the purposes and objectives of CRA. We strongly support modernization that ensures CRA does not lose effectiveness for LMI communities, and that it also creates a regulatory framework that streamlines financial institutions' ability to comply with CRA. The success of CRA reform should be measured by whether it will result in more credit and services delivered to LMI communities and doesn't create unnecessary regulatory burdens. We recommend updating and preserving the flexibility. MBA members believe that the current framework for CRA is effective, but it needs modernization to reflect changes in the financial services landscape. We strongly agree with the notion expressed by regulators and lawmakers alike that CRA examinations should be conducted in a more clear and consistent, transparent manner. We believe, however, this result can be achieved by modifying the existing framework. We have great concerns about the proposed metric-based single ratio framework outlined in the OCC's ANPR, and thus we oppose its adoption. We believe that the proposed single ratio metric is too simplistic to fit all banks. We believe that a single ratio would encourage a minimalistic approach to CRA compliance, where financial institutions would become more focused on hitting their ratio rather than thinking comprehensively about potential approaches for meeting credit needs of LMI communities. We believe that CRA can continue to be a powerful tool to promote investment in LMI communities, and to this end, we offer the following recommendations to the subcommittee on this very important topic. Create an MDI investment tax credit that can accompany the CRA provisions encouraging majority banks' equity investments in MDIs. The MBA strongly recommends enhanced interagency CRA training for examiners. The MBA recommends the creation of a robust public database of CRA case studies and peer performance data. We strongly recommend that CRA encourage banks to provide long-term support to MDIs and CDFIs, as we are established institutions that have a successful history of serving the communities that are most distressed. We recommend that bank investors receive significant and consistent CRA credit throughout the life of an investment, not just the origination of it. We recommend that studies of the assessment areas covered by CRA and the CDFI fund be streamlined. We also recommend that you streamline the reporting requirements of CRA and CDFI. The MBA recommends that CRA help promote financial literacy and inclusion among LMI populations, as well as unbanked, underbanked, and other vulnerable populations. The MBA applauds the subcommittee for holding this important hearing and for the full committee's ongoing efforts to assert and reassert the importance of CRA in the modern banking marketplace. And we stand ready to answer any questions.
Thank you. Mr. Glantz is now recognized for 5 minutes.
Chairman Meeks, Ranking Member Lukemeyer, Chairwoman Waters, pleased to join you and the rest of the committee today to speak about our kept-out investigation into modern-day redlining. Reveal from the Center for Investigative Reporting is the oldest nonprofit organization in the country focused on in-depth investigative journalism, and our weekly radio show airs on more than 400 public radio stations each week. My testimony today was prepared with my colleague, Emmanuel Martinez. First, a word about why we launched our investigation. We asked a straightforward question. Since 1977, banks have been required by the Community Reinvestment Act to lend in low-income neighborhoods and to low-income people. And yet, 40 years on, the homeownership gap between blacks and whites is as great as it was during the Jim Crow era. We wanted to know why. Why wasn't the Community Reinvestment Act reversing the historic damage of racially discriminatory redlining? So to find out, we analyzed 31 million mortgage records, nearly every loan application in America in 2015 and 2016. And we found 61 metro areas across the country where people of color were more likely to be denied a conventional mortgage loan even when they made the same amount of money, tried to take out the same size loan, and buy in the same neighborhood as their white counterparts. Atlanta, Detroit, Jacksonville, St. Louis, Tulsa, Tacoma, base towns like Killeen, Texas, Santa Fe, New Mexico, and right here in Washington, D.C. And yet, nearly every bank receives a satisfactory or outstanding grade under the Community Reinvestment Act. So we investigated further, and we found lenders were exploiting 3 big loopholes. The first we call the gentrification loophole. Because CRA is race neutral, we found that many banks loaded up, making a ton of loans in rapidly gentrifying neighborhoods that have historically been home to communities of color. We found that in these neighborhoods, banks offered generous terms, low down payments, a pass on mortgage insurance, even looking the other way on blemishes on applicants' credit reports. But almost all of those loans went to white newcomers. When people of color tried to get those same loans, we found they were more likely to be denied. Number 2, the bank branch loophole. Other people here have talked about how old CRA is and only applies to banks when they have a branch in a city that takes deposits. We found that in Boston, Philadelphia, and Washington, D.C., the biggest bank in America, JP Morgan Chase, was not assessed under the Community Reinvestment Act. Chase has a physical presence in these cities. It had an office for the wealthy here in DC across the street from the White House. But it wasn't technically a branch, and so it didn't trigger a CRA assessment. The result is that here in DC, Chase made more than 1,000 conventional home purchase loans in 2015 and 2016, only 23 to African Americans and 35 to Latinos. Now, after we published our investigation, Chase announced plans to expand its network in all 3 cities, and it will now be following the Community Reinvestment Act in those markets, but the loophole is still there. And the third loophole is about non-banks. The Community Reinvestment Act doesn't apply to non-bank lenders at all, and they make up an increasing share of the mortgage market. We took a look at the mortgage companies controlled by Warren Buffett's Berkshire Hathaway. We found that across the country, Berkshire Hathaway's mortgage lenders put most of their offices in white neighborhoods, hired a primarily white staff of mortgage consultants, and lent overwhelmingly to white borrowers in majority white neighborhoods. For example, in Atlanta, Berkshire's company made 1,300 loans for conventional home purchase in 2015 and 2016, included just 63 loans to African Americans and 46 to Latinos. And Berkshire is not evaluated under CRA. So finally, as a journalist at a nonprofit, nonpartisan news organization, I want to make one thing very clear. We take no position on any policy proposal. We are not here to offer solutions or advice. We are here to present the facts we uncovered in our 2-year-long investigation. One fact is that we found persistent redlining across this country, and another fact is that nearly every bank gets a satisfactory or outstanding grade under the Community Reinvestment Act. Thank you.
Thank you. And Mr. Roberts, you're now recognized for 5 minutes.
Thank you. Thank you, Mr. Chairman. Good morning. Good morning, Ranking Member Luetkemeyer, Chair Waters, and Chair McHenry, and the rest of the subcommittee members as well. The National Association of Affordable Housing Lenders is the only alliance of banks, CDFIs, and other capital providers for affordable housing and inclusive neighborhood revitalization. We support a strong CRA because America's economy, financial system, and society can succeed only if every person in every community has the opportunity to contribute to them and benefit from them. CRA provides the capital that is vital to the economic health of low and moderate income people and communities. In 2016 alone, banks made 3.6 million CRA loans, totaling $419 billion. That's a lot of money. That includes 2.7 million small business loans for $172 billion, 724,000 home mortgage loans for $108 billion, 26,000 community development loans for $96 billion, 13,000 multifamily housing loans for $33 billion, 108,000 small farm loans for $10 billion. Importantly, CRA is completely consistent with safe and sound lending principles, as the law requires and as experience demonstrates. CRA is sustainable for communities and borrowers and banks alike. But CRA could do far more. Banks are willing to make more loans and investments if they will get CRA credit for doing them. The bad news is that the CRA regulation is now 24 years old. It's fallen far behind fundamental changes to the banking industry, local community needs and opportunities, and the practice of affordable housing and community development, all of which have evolved greatly over the last generation. When the current CRA rule was finalized in 1995, Congress had just authorized interstate banks. Today, interstate banking comprises a majority of the banking system's assets. These days, mobile banking and other fintech innovations are helping banks to serve low and moderate income people and communities better as a convenient complement to branches, which also remain very important. And at the same time, CRA has not kept pace with reinvestment needs and opportunities. Low and moderate income people and communities are missing out on many loans and investments, either because it's unclear that they will count for CRA, or their location does not fit outdated CRA rules. The good news is that many important improvements are possible even within the current statutory framework. One area ripe for expansion is the financing of community development. Under CRA, community development includes affordable housing, economic development, community services, neighborhood stabilization and revitalization, and disaster area recovery. CRA has served as a foundation for an entire generation of successful community development practice and public policies, including the Low-Income Housing Tax Credit, New Markets Tax Credit, the CDFI Fund, and the Home Investment Partnerships Program, all of which are far more effective because of the participation of banks under the CRA. In fact, you could say CRA is the oxygen that community development breathes. To encourage more financing for community development, CRA policy should allow all large banks to have a consolidated community development test rather than fragmenting community development among the three current tests of lending, investment, and service. Give banks credit for community development activities nationwide if they have already served their local areas satisfactorily. Evaluate the substance of community development activities in all communities, including rural communities and smaller metro areas, where the current examination process effectively discounts and disregards those activities. Clarify the treatment of important activities like unsubsidized rental housing, economic development in struggling parts of the country, and infrastructure, so that banks can be confident when they make a loan or investment that it will count for CRA. CRA should also provide more credit for long-term community development loans and examine branchless banks on a national basis rather than as local banks. That concludes my testimony. Thank you.
I thank each of our witnesses for your excellent testimony, and I now recognize myself 5 minutes for questioning. And I'll start out with Mr. Van Tol. In listening to the reporting of Mr. Glantz, where he talked about the 3 loopholes, my concern has long been, discrimination that's gone throughout and the new style of banking that's going on now, whether we're talking about fintechs or whether we're talking about, a lot of banking deserts taking place. What would you think is the best way, as we talk about modernizing CRA, and we're in the middle of that, to try to eliminate some of those loopholes? And do you agree with Mr. Glantz's testimony as far as the reporting that he's done with those 3 items?
So I agree that those loopholes are an issue, and I think in particular, what we would say is CRA needs to cover more loans and more lenders. So CRA doesn't apply to mortgage companies, which today are a significant portion of the market. In fact, as I said in my testimony, CRA only applies covering about 30% of mortgage loans. That's loans that banks make in their assessment areas, and it's loans that mortgage companies make. And so we need to apply CRA 1 to mortgage companies, and 2, assessment areas should be drawn to cover the vast majority of a bank's lending. When banks are making a lot of loans outside of their assessment areas, effectively what they are doing is skirting scrutiny of CRA by doing that. And so we need to adjust the way that we look at both of those things.
And would you also agree that we can't just go by, I was concerned too by the initial findings of the OCC, although I give them credit for at least starting some of this dialogue with the metric-based single ratio, that we've got to be more imaginative than that to make sure there's more items that are included, so that, would you concur with that?
I concur. I mean, 1 ratio is really problematic. What it says is you take the sum of activities a bank does to fulfill CRA measured by a measure of capacity, their assets or deposits, and you do a simple division, and if they get above a certain threshold, you pass. What that would do is it would drive a lot of activity away from local communities, which was the original intent of CRA. It would drive activities to the most profitable, lowest risk, lowest effort type activities, likely very large mortgages in low and moderate income census tracts to middle and upper income people, because that's how you would sort of game a dollar figure amount. So we're not supportive. We're opposed to the one metric. We think it would be detrimental for low and moderate income communities and for communities of color.
Now, Mr. Mitchell, I'm concerned also. You are a CDFI, and you talked about the strengthening of CRA, and I know some of the larger banks that don't have the same model that you utilize, because CDFIs are basically there to help the communities. How would you talk about the differences between the CRA should work and apply? Because we even have some CDFIs, not yours, that has not complied or have, and I found amusing that some CDFIs, more so than some of the bigger banks, did not get CRA credit, where the big banks generally, I think some 96% all were found either satisfactory or better as far as CRA is concerned.
One of the concerns, Mr. Chairman, is that CRA and the CDFI requirements don't sync up. There's loans that can get CDFI credit that will not get CRA credit, and vice versa. The assessment areas can be different. If we have an assessment area for CRA purposes, it may or may not sync up. Generally, it would sync up with the CDFI census tracts, but there's differences between the two.
Should they sync up?
Yes, absolutely, and so should the reporting requirements.
And Mr. Odom, I want to, because what is important is critically important and central, I think, is access to credit. And when I look at, and I'm running out of time already, when I look at what took place with the great financial recession, can you describe and say how did that affect it, particularly African American and Hispanic communities, the loss of wealth, and whether CRA could have had a hand in helping us if it was assessed properly?
The Great Recession had a deleterious effect on black home ownership. Lots of African Americans, minorities, and other people across the country lost their homes. A lot of bank branches closed during that same period of time. So there's been a lot of reference here to banking deserts. Some of that root cause of banking deserts relates back to the Great Recession. A stronger CRA, especially one that doesn't, where policymakers don't blame the CRA for the mishaps, certainly like the Great Recession, goes a long way in avoiding those kinds of problems in the future.
Thank you. I now recognize the ranking member, Mr. Lukemeyer, 5 minutes for questions.
Thank you, Mr. Chairman. We got a law that's 40 years old, and everything needs to be reformed, I think, over the course of 40 years. I don't know anything that can't go 40 years without some sort of tweaks to it. So I think all of you indicated in your testimony that we need to look at different ways to be able to tweak this law, and I support that. One of the things that has happened is I think as our ranking member indicated, we're living in a world now with these sorts of devices that whenever a CRA was implemented, those were probably not even on the drawing board yet. So with regards to the many innovations in fintech, which have increased access to credit for Americans, what changes can be made to CRA that will promote innovation in lending while also ensuring banks provide services to the community in which they reside? Mr. Mitchell.
Well, as I said, one of the things that we believe strongly in at the MBA and in the CDFI banks is that larger banks, I think as one of my colleagues mentioned, can invest in MDIs. We have historically had a wonderful history and a successful history of investing in CRA designated areas and CDFI designated areas, and we believe we do it well. Our history has shown that Industrial Bank is the fifth oldest black-owned institution in the country, and yet there's others much older than us. And so we are proponents that the CDFI fund and large banks should be encouraged under CRA to invest in our institutions.
Mr. Roberts, do you want to answer that question as well? What do you think, how should regulators consider CRA credit for bank partnerships with non-bank institutions and fintech firms? How would you go about that?
So I think there are tremendous opportunities for those kinds of partnerships, and they can help further extend access to depository accounts as well as mortgages and small business lending. And those partnerships should be covered by CRA because the banks are playing important roles in them. In order to do that, though, there does need to be some revision to the way assessment areas work so that those activities can be recognized.
You know, this discussion that I'm having here, you know, it goes now into an area where, you know, is a lending institution providing different kinds of products and services across the board. And I think, you know, one of the things that I've had long discussions with Mr. Otting at the Comptroller's office with regards to his proposal, and I think part of his proposal is to try and enlarge the number of things that can be counted toward a CRA to be able to encourage investment in different areas that have not been allowed in the past. You know, things like churches, community buildings and groups, infrastructure, the number of ATMs and facilities in areas. And I think you mentioned, Mr. Roberts, also community development and affordable housing. So can you elaborate a little bit on how you would anticipate some of that coming out? Because I think if there is credit for it, I think there's encouragement in those areas for banks to be a part of that in an area where, in lending in an area where they maybe haven't been in the past or didn't get credit for it.
I think you're very correct. The key here, I'd say there are two key elements. One is we have to make sure that these activities are benefiting low and moderate income people and communities, and to the extent that they are broader, there can be a pro rata approach so that the focus on low and moderate income is maintained within the broader community. And second, there just needs to be a lot more clarity about what counts. Banks often won't know until an examiner comes through 3 or 4 years down the line whether an activity is going to count for CRA. So if you're a bank and you're operating in dozens or even hundreds of assessment areas, and you have multiple metrics to hit in each of those areas, then you really don't have time to focus on things that might not count.
You know, it's interesting because I think a lot of times the institution is not giving credit for being part of the community and doing those things. I mean, this is one of the things I think that Comptroller Otting is looking to do is he recognized that there's a lot of lending going on that the institution is not being given credit for that are enhancing the ability of a community to be successful, to grow, provide opportunities for people, and you know, and I guess my last concern would be non-bank regulation. Can maybe you want to comment just a second with regards to the high cost and predatory products of non-bank lenders, what we need to do to get a hold of that? Mr. Van Til?
Well, I think we need to apply CRA to them. I mean, look, CRA regulated lending is safer, sounder, it's cheaper.
What effect do you think that I have on those lending products?
On non-bank lending products? I mean, I think that bringing those companies into CRA scrutiny would be a positive thing.
Would it curtail the products that are being offered?
Pardon?
Would it curtail the products that are being offered and raise costs?
I don't believe so, no.
The gentleman's time has expired. I now recognize the gentlelady from California, the chairwoman of the Financial Services Committee, Ms. Waters, for 5 minutes.
Thank you very much, Mr. Chairman. I'd like to continue this discussion with Mr. Van Til about extending the CRA to these non-banks. I was informed that more than half of all of the mortgages issued last year came from non-banks such as Quicken Loans, and they have a larger share of the market than before the crisis, and that 6 of the 10 mortgage lenders are non-banks. And so while I absolutely support credit unions and the ability to serve their constituency, all of that, I mean, fair is fair. Can you tell me what has been the response to the question from not only members, but from the non-bank lenders themselves about CRA? Has there been any real discussion that you can share with us?
Sure. So let me go back to something that Professor Baradarian said. You know, she outlined the ways in which banks are really subsidized by the federal government. And I will note that the entire system of mortgage lending, in a way, is subsidized by the federal government. At the height of the crisis, we extended $30 trillion in loans, investments, and guarantees to ensure that liquidity continued to flow throughout the mortgage system. So I would say that in fact, mortgage lenders are subsidized in a similar way, and the rationale to apply CRA to them exists. They're not in favor of it. I think that some of them, we certainly see an institution like Quicken Loans does many CRA-type things in its headquarters city of Detroit, would probably do relatively well on a CRA exam. Many of the lenders are higher-cost lenders, are not doing the same kinds of positive things that they are, and we would be in support of applying CRA obligations to the whole market. We believe it brings scrutiny that will drive down the price of those mortgages, will encourage mortgage lenders to do more positive things for low and moderate income communities and communities of color.
Thank you. I want to move to Mr. Glantz. I want to thank you for the research that your organization has done, and much of what you have said is absolutely known by this Congress, and that we need to take that research into consideration in forming legislation. What is it that would allow a bank operating, for example, as you described with Chase in Washington, D.C., to be called not a branch?
The Chase office that was across the street from the White House still is part of their wealth management operation, and in the FDIC data set, it is identified as a limited service office, so it's making loans to the clients who go to that institution. It is not a branch that takes deposits, however, and the way CRA is written, if a branch is only a branch if it takes deposits. And so that is what Chase was doing in these three markets we mentioned, Philadelphia, Boston, and Washington, D.C. And as I also mentioned, they've since announced a branch expansion in those cities.
Is it fair to conclude that despite the fact it does not take deposits, that when you look at the overall company and you consider that their profits come from, you know, maybe all over the country and from various communities, is it fair to consider that perhaps that should not be the definition or the criteria for CRA enforcement, that we should be looking at making them CRA enforced also?
Oh, well, as I said, Madam Chairwoman, we're not here to make policy recommendations, but I would note that Chase was a very active market player in D.C., Philadelphia, and Boston, and in fact made over 1,000 conventional home purchase loans during our study period, and only 23 to African Americans. So they were not assessed, but they were an active market player.
And do you have any comments about the non-banks in your research?
One of the things that we noticed when we were out on the streets, a lot of our field reporting focused on Philadelphia, and that's how we ended up looking at Trident Mortgage, which is the Berkshire Hathaway affiliate there. It was the largest home purchase lender in Philadelphia, but it lent overwhelmingly to white borrowers. And it did not deny very many applications from people of color. It simply did not get applications from people of color. And that is what caused us to begin looking into Trident, because it was the market leader and it was not seeing any applications from people of color. And so,
thank you so very much. We're over our time, and I yield back the balance of my time, and thank you very much.
The gentlelady yields back her time. I now recognize the gentleman from North Carolina, the ranking member of the Financial Services, Mr. McHenry, for 5 minutes.
Thank you, Mr. Chairman. And thank you for holding this hearing today. I think it is important for us to note that the Community Reinvestment Act at the time was a landmark piece of legislation and has, for decades, served us well. And we've had this technology shift, a dramatic shift, actually born out of mainly the iPhone, right? And I mentioned in my opening statement, 95% of Americans have a cell phone, and that is a dramatic increase from 5 years before, and a dramatic increase from 5 years before. We have about 80% of Americans that have a smartphone, and that actually breaks down the total population, then every subgroup of population, ethnically, racially, is similar to that overall standard. We also have 13 million Americans that don't have a bank account or are considered in the realm of unbanked. We have urban areas that are left unbanked. We have rural areas left unbanked. We still have work to do. But this technology shift is something I'm really interested in, how you acknowledge that, and how we change CRA to actually meet what is something not contemplated at the time. And the reach can be so much better if those regulations, the impact can be so much greater if we update these regulations appropriately. And that's what I really want to get to. So how do you acknowledge the use, really, of the branch banking isn't what it used to be 15 years ago because of technology? And how do we update and acknowledge that impact? Mr. Roberts, can you touch on that?
Yes, thank you, Mr. McHenry. There are two things that could be done. One is to take into account mobile access much better under the CRA's service test, which today focuses primarily on branch location, which continues to be important but needs to be supplemented by a greater consideration of mobile access. And the second is to deal better with banks that really are branchless today. You can have an internet bank. It could be headquartered in Salt Lake City or Wilmington. Its only obligation under CRA is to Salt Lake City or Wilmington, even though it's taking deposits nationally and it's providing loans and other services nationally. And so that's just outdated. These are not a corner community bank in Salt Lake City. These are really nationwide institutions, and they need to be considered that way.
Mr. Odom?
There's no getting around the impact that technology has had on the financial services sector and many other sectors of the economy. They often, though, create a false promise of being able to radically transform the environment. Cell phones, in order for them to work as a payment device, have to have certain applications, have to be backed up by credit cards, have to be backed up by bank accounts. Within my neighborhood, where the National Urban League is headquartered, we don't have any vendors who take Apple Pay, for instance. Also, and I'm sure Mr. Mitchell could verify this, a lot of the small business relationships will probably always require some amount of face-to-face interaction between the borrower and the lender. So while I'm very encouraged by the rise of fintech, there are always going to be matters that have to be cared for, especially in communities of color. Even where technology adoption is at a high level, there are still some aspects of it that are going to require face-to-face kinds of interaction.
Right, but also technology is imperfect too, because if you can't afford a cell phone bill, you're cut off from job interviews, access to transit in many cases, and financial services. So I'm not saying it's a pure solution, but it should be acknowledged in some way and incorporated in sort of a modern regulatory environment, does it not?
Absolutely. Minorities are over-indexed for smartphones and for cell phones. That's not usually the problem. It's usually filling out a very detailed application on a 5-inch screen.
Right.
And sometimes present.
And that's an overall financial services problem and regulatory problem as well, not solved by this hearing. But thank you all for your testimony. Sorry to go on so long. Thank you. Yield back.
The gentleman's time has expired. I now recognize the gentleman from Georgia, Mr. Scott, for 5 minutes.
Thank you very much, Chairman. This is indeed an extraordinary committee of individuals that we have before us. I mean, your presentations have been very eye-opening, and I certainly want to say hello to Miss Barbara Duran. Did I get that right?
Baradaran, yes, close.
Bataran.
Yes.
If you say
Go
it
Dogs.
fast, it's go Dogs. And you got the red and black on.
Yes, you noticed.
I love Georgia. Welcome to the committee, ma'am.
Thank you.
Now, about 108 years ago, one of the greatest writers, literary geniuses, and educator, W.E.B. Du Bois, made this statement. He said, race is and will be the central issue and problem facing our great nation. 20th century. We're now in the 21st century. And his proclamation rings even true today, and nowhere does it ring truer than within the racial discrimination in housing for a home. And you all have stated some very brilliant things, but I wanna first of all, because I'm co-chairman of the bipartisan caucus on fintech, and this is a big issue, and I want to get some exchange from you all about how we can better address that. Now, my colleague Barry Loudermilk and I, my Republican colleague, we have introduced the FinTech Act. And I hope that you all may take a look at that. It basically sets guardrails. But we need a vehicle because Mr. Glantz, Mr. Odom, all of you raised some interesting points. But Mr. Glantz, I know you're not here. You said it 3 times, I counted it, that you're not here to make policy. But we are. And you gave some very profound and somewhat disturbing information. You said, number one, and this is where our technology and our fintechs come in, non-bank lenders are not even covered under the CRA. Now that opened my eyes to something I wasn't even dimly aware. We need to start there and deal with that. And then you said that every bank dealing with the CRA got top grades from the CRA. But then you said this, but you have evidence that target high rates of racial discrimination. How is that? Can you all explain? Because if we don't answer these questions, then this hearing is not going to be as worthwhile as it should be. If we got the CRA out there that's doing this, and then you got 98% of all the people dealing with it getting top grades, but from your all's devastating testimony, you're saying it's rampant, fulfilling W.E.B. Du Bois's projection into the 21st century. So can you help me with that, Mr. Odom, Mr. Vanto, Ms. Banaran, each of you, please. I'm at 40 seconds, I'm sorry. Maybe we can get it someplace else.
If I may start, Mr. Scott, I will say this. Discrimination results from a lot of things, and some of it is conscious bias, and some of it is unconscious bias. And some of the unconscious bias is probably not going to wane too much. And that's why I mentioned that I think some of the policies that help to address lending discrimination or disparities in certain areas should address supporting those institutions like MDIs and CDFIs that do that lending in a vast majority of what we do as institutions ourselves.
All right. Thank you, Mr. Chairman.
The gentleman's time has expired. The gentleman from Colorado, Mr. Tipton, is recognized for 5 minutes.
Thank you, Mr. Chairman. Appreciate you holding this hearing. And I think I hear general consensus that when we're looking at the CRA right now, that it is failing in some instances to be able to adequately supply credit, financial opportunities to some of the low and middle income communities. But it seems to me a lot of the focus is just on urban America. I'd like to be able to expand that out a little bit to rural America. As Ranking Member McHenry had noted, we have 13 million plus people that are not banked or underbanked in the country, and a lot of those are probably in areas much like mine. I have a district that butts up against Utah, New Mexico, Arizona, and Wyoming, a broad swath of rural Colorado. And last year, that was part of the purpose of actually introducing legislation, which ultimately became law for the mobile banking, to be able to allow customers to be able to open up a bank account simply by scanning their driver's license, to be able to start to create some of that access. And as we're listening to the conversation right now and some of the branch bank closings that we are seeing, just in my state, we lost 19 more bank branches than were opened in 2018. And thought it was interesting that a Federal Reserve Board report noted that mobile banking is rising over the course of the recent years. And the report goes on to suggest that mobile banking can help address some of the challenges that consumers face in the decline of those physical branches. And so, Mr. Roberts, you'd address this just a bit in regards to Mr. McHenry's questions that have come up, but if we are losing these local branches and the access to being able to go in, with mobile banking, can it help customers actually address and access some of the needed financial service products? And wouldn't it make sense to be able to expand CRA activity past those delineated assessment areas into areas where the bank's actual activity is taking place?
Yes, Mr. Tipton, that would be very helpful. Part of the challenge for CRA is that for the larger banks that cover multiple states, urban and rural communities, they get very little attention in their CRA examination on their work in rural areas. So in some ways that's understandable, because if you're an examiner and you've got a lot of territory to cover for a bank, you want to focus on the places that are generating the most deposits, but those are always the largest metropolitan areas, and then you never really look at what's going on in the rural communities. So we think there should be changes to consolidate the examination of rural areas within a state, so they'll have more market presence within that examination process, and to make sure that the substance of the activity and not just the top line numbers are really considered, so that banks can get recognized for doing the important but oftentimes very difficult work in rural communities.
And I appreciate that because as I listen to the conversation, and you're exactly right, the focus is on concentrations of population and resources. And one of the frustrations that many of us that come out of rural America have is the loss of 10 jobs could extrapolate into the loss of several thousand jobs, as an example, into those urban areas. And we don't want those people to be forgotten. They have families as well that they want to be able to provide for, and to make sure that we're actually incentivizing our banks to be able to do what I can tell you our community banks in my district want to be able to do. And that's to be able to reinvest in those communities, to be able to help them grow, and to be able to create those opportunities for families to be able to stay in the areas that they live and they love. This question, Mr. Roberts, maybe you can start, and we can just go down the line with our panel here. In terms of CRA examination results, being able to get those in a timelier fashion rather than a few years later, you don't know exactly what you're doing, and to be able to give clarity, which has been brought up by the panel as well, what actually qualifies for CRA. Would those be useful things to make sure that we're incorporating in?
Absolutely. If you look at the biggest 6 banks, the most recent examination for any one of them covers 2013. I think for 3 others of the 6, it's 2012, and for 2 others, it's 2011. So if you're not getting feedback, either as a bank or as a community, about performance, it becomes as meaningless as an X-ray that you don't receive for 2 or 3 years.
The gentleman's time has expired.
Thank you, Mr. Chairman. Yield back.
The gentleman from Missouri, Mr. Clay, who's also the chair for the Subcommittee on Housing, Community Development, and Insurance, is recognized for 5 minutes.
Thank you, Mr. Chairman. And Chairman Meeks, let me thank you for holding this hearing and shining a light on predatory practices of redlining of mortgages and small business loans. And I look forward to working with you in that area to eradicate it, to eliminate it in our economy. So let me try this, Ms. Bataran. In an article published in the Washington Post, you wrote about the need for more government intervention, not less, in order to address the racial wealth gap in communities like mine in St. Louis, which have suffered from historical discrimination in housing, banking, and health care. We have seen a regression as many people are still trying to recover from the financial crisis of 2008. In your testimony, you suggest that the CRA test should resemble the stress test that the Federal Reserve administers, focusing on outcomes and not just actions taken. Could you could you discuss that a little and tell us, should we incentivize lending in, say, opportunity bank zones, or should we prohibit all of that discrimination in the area based on zip codes? I would just like to hear your thoughts on that.
Thank you. One of the things that happened before the crisis is we had a bunch of regulatory box checking for safety and soundness. So camels and all of this stuff was basically, you know, do you pass, do you not? And what happened during the crisis is those things did not catch the outcomes. Is this banking sector safe or not? And so the stress test on the Federal Reserve said, let's look at outcomes. Let's look at the totality of what the bank is doing and see, do you have enough capital or not? And so I think if we're looking for the CRA to fix the racial wealth gap, which we should be because the federal government created it in the first place through those red line maps, then we should look at the outcomes. Are you infusing capital and wealth into these communities, or are you not? Not, did you do this, did you do that, because those things are not outcome tested.
So it's just checking a box, really, the CRA examinations now.
It sometimes amounts to that, and as you know, the other panelists said, it's really easy to find loopholes, and if banks are not incentivized, these are low-profit loans a lot of times, and so banks are going to be incentivized to find those high-profit areas or somehow find a loophole in that, and so outcome-oriented tests, like the stress test, block those loopholes, and they look at what is the result.
And if we're going to online lending, then wouldn't a good indicator be where you place these loans by zip code?
Yes, and let me say something about fintech, because we keep bringing that up. Every fintech company uses a bank partnership to access that payment system. Fintech is not this non-bank product. They link up with a few banks around the country that use loopholes to get into that payment system. And if you want to use Venmo or Square as a consumer, you need a bank account. So 1 in 4 Americans is unbanked, and those people need brick and mortar services to put their cash, to pay their bills. And they're spending 10% of their income just to use their money.
Thank you for that. And Mr. Van Tol, being that redlining and other forms of discrimination primarily impact low to moderate income and racial and ethnic minority populations, what steps should policymakers consider in strengthening the CRA?
Well, among other things, they can strengthen the fair lending reviews that are conducted as part of the CRA exam. That's really the way that race comes into CRA. Unfortunately, the OCC has weakened those reviews, resulting in fewer CRA downgrades for racial discrimination. That's one significant way it could be strengthened. There are other ways. The American Housing and Economic Mobility Act, which was introduced as S787 and HR 1737, would modernize CRA, apply it to more loans, to more lenders. We're supportive of designating areas that are receiving relatively low loans per capita as underserved areas and providing CRA credit for that. That would result in more urban areas and more rural areas that are receiving very little in the way of lending more scrutiny under CRA and would go a long way to addressing redlining and historic disinvestment in those communities.
Thank you all for your responses. I yield back.
Gentleman's time has expired. I now recognize the gentleman from Texas, Mr. Williams, is recognized for 5 minutes.
Thank you, Mr. Chairman, for calling this hearing today. And the business of banking has changed drastically since the Community Reinvestment Act was signed into law in 1977. One area in particular that I think is outdated is the geographic assessment area. Many people now are turning to online banking and other methods that make physical branches less relevant than they were back in the 70s. So my question, Mr. Odom, to you is how would you modernize the assessment areas to ensure that most people are being helped under this law?
Well, this is a subject that's been taken up in the advance notice of proposed rulemaking, and I believe some of the parties who have submitted comments on that point are here today. It's not certain to me that the rise of the geographic assessment area is fundamentally flawed. I understand that the rise of fintech, as we've heard today, is something of which to take notice, but all of those relationships are going through established banks that have geographic presence in certain parts of the country. So I'm very eager to hear what the regulators do in the rulemaking with respect to the definition of how to assess geographic areas, but I'm not sure that is the home run to fix the CRA.
Okay. I've heard that the number of qualified investments for CRA credit is too narrow. In many cases, banks are cautious to loan money to projects that are innovative out of fear that they will be not ultimately count towards CRA requirements. So, Mr. Van Tol, how would you recommend amending the definition of qualified investment to allow for innovation and a greater number of activities to be eligible as CRA investments?
Well, let me just make a distinction. I think, when I was in school, if half the class failed an exam, we said, well, we weren't quite clear on what we needed to do to pass. But in this case, 98% of banks pass. They're actually doing a good job of passing the exam. It's not the case that they don't know in the aggregate how to pass the exam. They do it all the time. Most of them pass, the vast majority of them. What they don't always know is, am I going to get credit for this investment at this time? They do need clarity to know in real time whether or not an investment strategy that they're undertaking qualifies for CRA credit. I think in many cases, it's a matter of guidance. It's a matter of providing feedback. It's a matter of training examiners and making sure that there's consistency, not necessarily a matter of changing the definition or qualifying more activities. Again, banks already qualify a great number of activities. They're passing their exams with flying colors.
Thank you. Mr. Roberts, in your testimony, you list a bunch of ways that the CRA can be improved upon, one of which is getting the performance metrics right for CRA performance. So how do you think banks should be rated for their performance with CRA activity?
What we could use is more clarity and transparency for how those metrics are applied. Some have commented on the idea of a simple ratio of dollar volume of lending activity relative to a bank's size. We're concerned that that could generate some unintended consequences. For example, rural areas and smaller metros often have more affordable home prices, but that also means that the mortgage amounts are smaller there. It's already hard to make money on small balance mortgages, but if the metric is just getting to a dollar target, then banks will be incented to really focus on higher cost markets where they could make a loan to a high-income borrower in a low-income neighborhood for, say, $750,000 rather than 10 loans for $75,000 in a low-income rural area. So we just have to get the metrics right, but I think with better clarity, both about how things are measured and how they are then added up within the exam, we can make some progress.
Okay. I believe I'm done with my question. I yield my time back.
Hey, I got one quick question with regards to Mr. Toll. You know, we had, you made a comment a while ago that you didn't believe that there was an extra cost to putting any rules or regulations on lenders, on non-bank lenders. Did you intend to say that?
No, I don't believe I said that.
You don't think there be any extra costs if you're putting some rules and regulations on non-bank lenders?
No, that's not what I said.
Okay,
That's
I
not
misunderstood. What did you say then?
Well, I think that applying CRA to those companies would impose a cost. I think that it actually might lower the cost.
My follow-up question then will be, do you think that'll restrict services and products to people as a result of that?
No, I think the evidence of CRA is that it's expanded services and loans.
You just contradicted yourself there, sir.
Gentleman's time has expired. I now recognize the gentleman from Illinois, Mr. Forster, for 5 minutes.
Thank you, Mr. Chairman, and thank you to our witnesses. And I guess I'd like to start by thanking Ms. Baradaran. Did I do that right? For your shout out to Senator Bill Proxmire. I grew up being driven around in a rusty Studebaker with one of these triangular masonite signs with Bill Proxmire's name on it. My mom actually ran the finance operation for Bill Proxmire's reelection campaign, and the entire finance operation for a Senate reelection campaign back then was one part-time faculty housewife. And so that tells you why you had senators with enough time to think deeply about the problems that our country faces. And I think, you know, the encroaching of fintech and the implications for community reinvestment are just a perfect example of that. Now, when you look at this, it's clear that we're going to need some new metrics for reinvestment. What's meant by reinvestment when you look at these fintechs that collect money nationwide. And there seem to be two different goals there. One of them, socioeconomic and racial equality, as one of the things we're trying to incentivize. The other one is to balance the outcomes for different communities, particularly rural and urban. And I'd like to ask first about that one. You know, if we were talking about Colorado recently, and in Colorado, we know what the solution is there. The silver mine runs out of silver and you get a ghost town, and everyone moves to Denver and they're doing okay. Should the Community Reinvestment Act have prevented that? Or not? What do we do when the coal runs out or stops being mined in communities? Do we have a responsibility to communities to keep them alive when there is no longer an economic reason for them to exist? And to what extent should we lean against that natural operation of the free market? Does anyone want to take a shot at that?
There have actually been some banking institutions in the face of these headwinds, technological changes, changes in the economy, have actually doubled down on bank branch activity. There have been some, probably you've seen some commercials with Capital One actually creating bank branches that do more than just take deposits, take applications, and do other sorts of things. I think the appropriate balance is not to assume that the secular trends that we're seeing in rural areas or urban areas with respect to bank branches being gone or lending activity being gone is a permanent one. I think there are good actors out there who are trying to figure out what the right mix is.
But should we? How hard should we try to convince them to continue reinvesting in this ghost town that's developing?
Well, let me say, I mean, the beauty of CRA as currently constructed is it's responsive to local needs, the performance context in the community. So if the economy is bad, you would expect CRA to motivate institutions to invest in economic development. And certainly not every area can the banks dramatically transform the town, but you do see those kinds of investments. And that's a structure that we're very concerned that the OCC has proposed, looking at the definition of community and defining it more broadly. We urge that the definition intention of CRA being responsive to local community needs, really measuring what's going on in a community, measuring how well a bank is responding to those needs. Certainly not one bank can save a town like you described, but it can recognize that the need there is very different from a place that has a thriving economy, lots of people moving to it. There you would be concerned about displacement, gentrification, maybe the economy being too hot.
Right, and so along those lines, the second goal is socioeconomic and racial equality. And so, for example, you might want to adopt policies that if someone their neighborhood was undergoing gentrification, you might do something to make them stand up and then survive the gentrification better than they otherwise would have, or provide opportunities, low-cost rental things that would not necessarily be provided by the free market. And so has anyone ever tried to just write down a metric that might incentivize the broad range of all of these different goals that we have? Maybe I'm thinking about opening up a sandbox for the fintechs to play in, let them take the money that they're collecting nationwide and try to game a certain rule and see if that forces them to put money where it's actually accomplishing our goals. Has anyone tried to make a general purpose metric that might steer the money where we're all trying to find a way to make it go?
I mean, let me go back to Proxmire here. I mean, what Proxmire understood here is that some of these communities the investments are not going to be the highest profits, but that's okay because banks have public duties. And so not all rural communities are created equally. Some are, the people have left, but there are still lots of communities where people are not leaving. Banks are easy, global, money moves faster than people can leave their hometowns. And so in these communities where people still exist, they're going to school, they're thriving in these communities, but their banks are gone. And so those are the communities that we're focused on. And some of them are not going to be the highest profits, but banks still have public duties, even though there aren't high profits.
If I can just add to that, you have a CDFI fund that produces a positive return on investment for the taxpayers, and it is woefully underfunded, and every year during the budget process, it seems to be on the chopping blocks for elimination when it should be increased.
The gentleman's time has expired. I now recognize the gentleman from Georgia, Mr. Loudermilk, for 5 minutes.
Well, thank you, Mr. Chairman, and I appreciate the opportunity to have this hearing today. Something that's very important. I am, from my knowledge of the Community Reinvestment Act, it's served a great purpose in this nation, and we're, in fact, a better nation because of changes in our society, changes in business models and such. And I commend the OCC for looking at bringing the CRA up to date. When you look at the changes in society, you look at the changes predominantly in technology. With technology, with fintech, these are bringing banking services to areas that were traditionally unbanked or underbanked. And it's important, as my colleague said, have sandboxes, the ability to get into these areas and see how these new technologies can actually enhance the original purpose of the CRA. And so I believe in, and I think giving the OCC the ability to make reforms collectively with all three of the banking agencies to make sure that the CRA is meeting its original purpose and doing it effectively and with the new technologies is very important. But one of the problems that I've particularly seen and heard with, especially with our community bankers in Georgia, is inconsistency with a lot of the CRA exams. And for instance, some of the services, loans, and investments may receive CRA credit at one bank, but not another. One example that was given earlier is, does partnering with a nonprofit qualify for CRA credit? That could be interpreted in different areas by different examiners. So, Mr. Mitchell, do you have recommendations about how we can address the inconsistencies in these CRA exams?
Training. First of all, training. I think also having a database that shows which projects qualify. Individual banks from time to time has come up several times this morning, are not sure whether a particular project that they invest in or may invest in or lend to would qualify. And I think if there's a database that answers these questions, then the bankers can go online and see that someone else has invested or lent to a particular project that did qualify. Okay. So the clarity and training among examiners is critical.
Mr. Roberts, I saw your head nodding. Would you have something you'd like to add to that?
I agree, but I'd also suggest that the banking agencies should have specialized examiners for CRA. The same examiner who's doing anti-money laundering exams and other kinds of compliance exams or safety and soundness exams simply isn't going to know enough about not just CRA, but also how banks are really responding to local community needs. And to understand that is just a very important factor and would go a long way toward consistency.
Well, Mr. Roberts, while I have you, going from inconsistencies and how we can address those, I want to go to the extensive time that it takes to actually receive exam results. To me, that seems like the longer banks are waiting for their exam results to come back, the less confidence they have that they're meeting the goals, and therefore delays serving certain communities and demographics that they would really like to be able to target for CRA and for their credit. And as we've seen and has been testified to, that the CRA compliance is generally strong, and banks are genuinely interested in fulfilling these needs. Do you think that these delays cause significant problems in banks meeting these needs, and how can we address it?
Tremendous problems. Banks are really flying blind. They don't know whether the examiners and agencies think they're doing a good job or not. They can't see the areas that might be identified for improvement. They can't see the areas where they're excelling and can double down and do even more in that area. And communities can't see what the banks are doing and how well they're doing so that they can engage more constructively with the banks.
What can we do to fix this? Is that part of some of the modernization that we need to look at and reforms?
Yes, we recommend that that performance evaluations be published within 12 months of the close of an examination period. So if you've got a 3-year examination period that ended at the end of 2018, you should have your CRA rating by the end of 2019.
Yeah. Thank you. I yield back.
Gentleman's time has expired. I now recognize the gentlelady from Michigan, Ms. Tlaib, for 5 minutes.
Thank you, Chairman. Thank you all so much for being here and for your incredible work. I want to share a story. I used to walk down my block, for over 30 years, but even down my block, where I knew every single homeowner. It was a predominantly beautifully diverse block. Some were even born in their home, right? Some were able to keep their home for 70 years through 3 generations. And growing up kind of in the 80s and 90s in the city of Detroit, leading the nation like 70% in some neighborhoods of home ownership was pretty incredible. It stabilized not only our school system, our environment, even economically. We saw more and more neighbors being able to stabilize themselves and be able to provide an incredible future for their children. And the percentage of African Americans who own their homes dropped in Michigan more than any other state, down to 40% from just over half in 2000. The decrease has been greatest for middle-aged Black Americans in Michigan, ages between 45 and 64. I think it was 60% in 2000 to down to 41% in 2016. Much of that decline was in the city of Detroit. We flipped from a majority home ownership to now 54% of my residents are renters. I, essentially have been listening to this hearing and really understanding, what the purpose of CRA was, which is, currently now understanding there are loopholes and it needs to be updated. It's based on geography, and banking institutions are skimming the larger, more profitable, low and moderate income communities and lending to higher income borrowers. That's the data I've been reading. So their loans meet the CRA requirements and regulations. So, Mr. Mitchell, let's say you're in a low, moderate income neighborhood, like the one I grew up in, one where I'm raising my boys in, where the borrower is making 125% of the AMI and a borrower making 75% of the AMI. In your opinion, which borrower would the banking institution mostly lend to, most likely?
Well, that depends. We have a history as an MDI and a CDFI of getting behind the numbers and looking at the story. It's an integral part of how we do business. And this is why you should have concerns about non-bank lenders, because they don't have the ability to do that. Their algorithms don't do that. So we look at the story. And we look at what you're telling me, and we back it up with our own due diligence and research, and it depends, because we could lend to either one.
Yes, but under the CRA, though, the banking institution would still receive the same CRA credit for lending to a higher income borrower in an LMI neighborhood as they would a low income borrower, correct?
Yes. We would do both in that case.
Both. In my congressional district, where there is little incentive to lend to LMI communities, the CRA is of little benefit to my constituents at this time because banks will not issue mortgages for less than $50,000. Forcing them to borrow from non-banking institutions, such as Quicken Loans, as the chairwoman mentioned, which is a leading mortgage loan creator in my district. Which leads me to the next question, and this one is for Mr. Odom. Mr. Odom, would you say that because the non-banking institutions aren't obligated to follow CRA, that borrowers are more subject to payday lending and discrimination and redlining because of this loophole?
I believe that certainly plays a role, Congresswoman. We have seen the rise of non-bank institutions, particularly in the census tracts associated most closely with African American and minority owners. They filled a void, they filled the vacuum that's been created by the lack of lending by a lot of CRA covered institutions. We've talked a lot about non-banks and banks today. And I think the message that I'd like to send to you is whatever regulatory structure we land on, it should be a leveling up of our regulations, not a leveling down. A lot of non-bank organizations rightly are young, they're new, they've not grown up in a regulatory environment, but we have to resist the impulse to say, well, because we have new entrants who are taking market shares, the incumbents should follow their lack of regulation. That's what we're saying here. We've not figured out what this regulation is going to look like, but we should be going to the highest measure, not the lowest common denominator.
Thank you. And Mr.
The
Chairman,
gentlelady's time has expired.
If I may, just wanted to submit an article, loophole in law for the poor spurs gentrification into the record.
Without objection. The gentleman from Tennessee, Mr. Kustoff, is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you for calling this important hearing this morning. And I do want to thank all the witnesses for testifying this morning. Mr. Roberts, if I could, my district is West Tennessee, so I've got the suburbs of Memphis and then West Tennessee and some rural parts of West Tennessee. Recently, I had the opportunity to speak to a roundtable of bankers from really all around my district, and one of the topics was around CRA modernization. One bank in my district told me that they were recently required to open up a branch really for CRA purposes, and that because of that, it's losing about $100,000 a year annually. As we look at the CRA and the way it's constructed and what's required of the different communities, it seems like that regulators increasingly have included in their CRA examinations criteria, in my opinion, that may not be related to CRA, including compliance with other financial laws or consumer regulations that have their own standards and penalties for violations. An example for banks in my district is that the banks are being subjected to fair lending questions during their CRA exams. With all that said, we've talked a lot this morning, and you all have talked a lot about modernization. How do you envision modernizing CRA to best suit the needs of the 21st century financial institutions and the communities that they serve, including some of these rural communities?
Yes, Mr. Kustoff, rural communities certainly need much better consideration under CRA. They're often overlooked in the CRA process because they are smaller than the larger cities, and so the examiners tend to focus more on them. But there are a number of things that could be done to remedy that.
And what are some of those areas?
One thing that we would suggest is that oftentimes rural areas need economic development. Mr. Foster had raised the anecdote of a town that loses its primary employer. And CRA should do much more to recognize economic development efforts in distressed communities, urban and rural. So that, and it's not just a numbers game. Even a small loan or investment can sometimes make a big difference in a small community, but it gets overlooked because of its size. So those are some of the things we would suggest.
Okay. I appreciate that. Lastly, if I could, revolves around financial literacy. And I do think that the banks in my communities do a pretty good job of trying to educate through financial literacy. And in fact, this week is Financial Literacy Week in Tennessee with our community banks. What I've heard from my banks is that unless financial literacy is done in very specific areas, it doesn't count towards those CRA requirements. Do you believe that these requirements should be or could be modernized, if you will, to allow for education done within a bank's footprint to be counted towards the CRA?
Yes, I think it could be done, and you can maintain faithfulness to the low and moderate income focus on CRA by simply taking a look at, what share of the broader community is low and moderate income, and provide pro rata credit for those broad activities based on that, so that you don't reject those activities entirely because they're not specifically targeted, but you recognize that a community that is, say, 40% low and moderate income is really benefiting in a different way from a community that is 10% low and moderate income.
Thank you, and I yield back the balance of my time.
The gentleman yields back the balance of his time. I now recognize the gentleman from Utah, Mr. McAdams, for 5 minutes.
Thank you, Mr. Chair. I want to thank the panelists for their testimony today, and I want to thank you, Mr. Chair, for holding this important hearing. I also want to give a special shout out to Professor Baradaran. I've had 20 years to practice her name, as we're personal friends going back some time. So not only is she a BYU grad from my state of Utah, but she practiced law at the same firm I did, Davis Polk and Wardwell in New York. So it's great to see you, Professor.
Good to see you, Ben, Mr. McAdams.
The CRA has been an important tool in my district, at both serving the credit needs and driving investment to many of Utah's communities. And I want to ensure that we don't weaken the CRA in any of our reform efforts, but I've also seen the shortcomings of the current CRA structure. As the mayor of Salt Lake County, I often teamed up with many of the financial institutions in Utah to pursue innovative investments. For example, Salt Lake County pioneered many of the first pay-for-success or social impact bond programs in the nation. We expanded access to early childhood education, we targeted homelessness, and we reduced recidivism in our jails. And we couldn't have done these projects without our financial partners. But what I learned while working on these projects for CRA credit was that what I learned while working on these projects is that the financial institutions we partnered with often didn't do these projects for CRA purposes. They said it sometimes just wasn't worth the hassle. It wasn't worth jumping through the hoops to prove to their regulators that the projects were CRA eligible. Oftentimes, they wouldn't have that certainty until long after they had needed to make a commitment for the project, so there was a lot of uncertainty in their CRA boxes they had to check. So instead, they would rather do the same lending or investment activity they had done the previous decades without any indication that these projects were really what the community needed, because they knew that those investments would be CRA eligible. So the system we have today kind of forced them or incentivized them to do the status quo and go through the motions of that rather than innovate and think about more creatively how they can reach into the populations we're trying to help. So when considering CRA reform, I want to preserve both the spirit and intent of the CRA to benefit low and middle income in communities and individuals, but I also want to push financial institutions to innovate, to push beyond their comfort levels, and to try new data-driven projects without the fear that they would be punished by their regulators for taking a chance on their communities. So, Professor Baradaran, I think there was a great discussion about And I appreciated in your comments about the focus on outcomes rather than simply checking the box. So as a local mayor, I saw that as well, that we just encouraged and rewarded checking the box rather than focus on outcomes. And shifting to that focus on outcomes. So first, just an editorial comment. I'd like to see local input on what some of those outcomes might be. But then once outcomes are identified, as we're looking at what strategies might be deployed in our communities to extend opportunities to those populations that we're targeting, what can we do to create some certainty, maybe approval of a CRA-eligible activity earlier in the process, to know that these strategies would be, what I'd like to see CRA accomplish is to encourage innovation and forward thinking rather than risk-averse activities that in the CRA. To encourage that type of innovation and risk-taking. And to some extent, I think the shift to outcomes is important, but I worry that doing that introduces even more uncertainty into the process and discourages financial institutions from innovating and pushing the limits. So maybe Professor Broderick and then any others who want to comment on that.
Yeah, I mean, Utah is actually a perfect example, and the problems that you, as mayor, looked at is homelessness, right? So you have this huge problem, and then the solution that you had, but you needed bank funding. And Utah happens to be the home of many of these fintech banks whose assessment area is really undefined because they're basically partnering with these global fintech networks. And so here you have a problem, and then you've got these CRA duties, and there should be a way to match those. And so this is where aligning incentives needs to be done at the regulatory level. Is banks should definitely get CRA credit for partnering with public institutions and mayors and other places who have sort of shovel-ready projects ready to go. And so, yes, there is some uncertainty with outcomes, but I think it's, when students come to me and say, tell me exactly what to do to pass this test, I would rather say, look, know the materials and you'll get a good grade. And so I think that's what I would say to banks is do your duties and you'll pass the CRA. Don't look for the least you can do just to check that box.
And CRA gives credit for innovation. Part of the problem is innovation is defined as really something that's never been done before rather than something that's really responsive and innovative and to a local need. And so we are supportive of specialized CRA examiners, of more training for examiners, of more guidance, of more certainty in real time as to whether or not an investment is going to qualify or not. To your point, they will do the investment and then argue later that it will qualify, and many of them do qualify and are successful in doing that. It's the hassle and the not knowing whether or not they're going to get credit that creates it.
Gentleman's time has
Thank you.
expired. Now I recognize the gentleman from Virginia, Mr. Riggleman, is recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you all for being here. I know it's been a long morning going into afternoon, so thank you very much for being here. I want to read out directly from the Federal Financial Institutions Examination Council's website on the purpose of the Community Reinvestment Act. I'm actually doing this for a reason, believe it or not. So the CRA, and I quote, is intended to encourage depository institutions to help meet the credit needs of the communities in which they operate, including low and moderate income neighborhoods, consistent with safe and sound banking operations. And I just want to get where my questions come from. My district in Virginia, and I know it's hard to believe, but I have the most rural district in Virginia, and it's bigger than the state of New Jersey and parts of Delaware. Also, when it looks at the disparate income in my district, and I don't know if you guys I don't know if any of you have actually had to deal with districts like this, but in the northern part of my district, we have a median family income of $91,000 per year. In the southern part of my district near the North Carolina border, it's $35,000 to $37,000 per year, and that's a $55,000 to $60,000 delta. So the questions that I'm asking are actually based on the fact that when it says low and moderate income neighborhoods, I have low and moderate income regions. I have one county that's massive that has 7,800 people. So when you see these questions I'm about to ask, and I'm going to roll through them because I know you guys have been busy, but I am very interested in what you think about some of the issues that we're facing, in the parts of my district that I have. And I fully support the mission of the CRA. I think a lot of it, when I talk to the bankers in my district, it's about the enforcement supervision. And I had one banker in my district, he told me a story about how an examiner was in his institution, and after reviewing a loan file, the examiner okayed it for CRA credit. And a year later, another examiner came in from that same institution, right? And he's been, and listen, this banker's been serving his community for years, and then said that actually the file was wrong and it did not actually, he could not get a CRA loan, right, for that exact same file. And that frustration in my district has been pretty noticeable. Not only that, again, I think it's because we have a limited number of banks and we have such a large area. And I know this is a yes or no question, and it's because I want to go to the next thing, and we could take a while. But and I wouldn't think does anyone on this panel think that this sort of examination on CRA, and that's where you have this sort of inconsistency in regulatory models, helps institutions meet the credit needs of their communities, yes or no? No? So, and thank you. I just don't think anyone on this panel or otherwise could argue against a regulatory structure that is clear, consistent, and works for all impacted parties, including the lenders. And again, when I go back to these questions, it really comes back to the simple fact that I have such a unique challenge in my district, even under CRA, that it just puts us in a really incredible position in trying to get loans for these disadvantaged communities that are so widespread. And I would think that if we had a regulatory structure that is clear, consistent, and does work for all impacted parties, including the lenders, the reason I think it's so important is because I want to incentivize financial institutions of all sizes to comply with the laws and regulations, right, and coming on the government to ensure equal and tailored treatment. So it's a little bit of a switch here because I think fair treatment is the rationale for the CRA. And I would say, Mr. Van Tol, I had a question for you. And it really does come down to my banks and the questions that I have. And by the way, there's no vitriol in this whatsoever. Why does NCRC oppose recommendations to relieve regulatory burden on small and intermediate banks under CRA by increasing the thresholds for these respective CRA tests? And so the question really is it appropriate to subject a $1.3 billion bank to the same community development standards as a $100 billion institution, even based on the facts I gave you about our district?
Well, as I said earlier, those institutions, intermediate small banks, do about $3 billion in community development loans and investments each year. And that is the size of the entire HUD CDBG budget, which is a critical source of community development financing in rural communities. So if you were to exempt those institutions, you would likely see $3 billion a year in community development investments in your district and elsewhere, especially in rural communities, go away. And that's why we're opposed to it. We think it's a significant source of community development financing for underserved rural communities and urban communities alike.
Yeah, and I appreciate that. And I think part of it, too, is that just based on size, it's also the consistency of the regulatory, burden that they sort of carry. And I think that's the problem that I have with this, is that if it's a one-size-fit-all with inconsistent regulatory structures, you really can have a lot of confusion, which happened when I started companies also, right? You have multiple, you have confusion. And I know we have 28 seconds. And Mr. Roberts, in that 28 seconds, can you explain why counting farm loans based on distribution or volume versus dollar amount is important to ensure equal proliferation of CRA?
Sure, because those loans are small. And if all you're looking at is size, those loans are just not going to move the needle on a CRA review.
Yes, thank you very much. I know my time is up, and I appreciate all of you. Thank you, sir.
Gentleman's time has expired. And I recognize the gentleman from Washington, Mr. Heck, for 5 minutes.
Thank you, Mr. Chairman. I'd like to direct a question to Mr. Van Tol, Professor Baradaran, and Mr. Mitchell. When the CRA was originally adopted, it had to do with making sure that people weren't being locked out of access to mortgages to buy homes in redlined areas. Obviously, we still need to be incredibly vigilant for that policy objective. But frankly, I worry also that the threat has changed and we have not adapted to it. It's also now, frankly, whether or not somebody can find a home to purchase. In the 1970s, by comparison, we were building 12,000 homes per million people. 12,000. Today, we're building 4,000 homes per million people. And so there frankly aren't anywhere near enough homes to go around for people who aspire to home ownership. And that disproportionately burdens people of color and people of low income. So I'm frankly wondering if there's any way in which the CRA can help address this in redlined areas. My personal point of view, developed over a long period of time, is that we frankly got a problem with respect to construction lending in particular. And I wondered if the CRA can or should be modified to encompass construction lending, especially for workforce housing. We have passed out of this committee a very ambitious, which I enthusiastically supported, ending homelessness bill. But we still have the issue, I believe, of market rate housing, especially workforce housing, enabling people to stay in the communities they live and be able to actually buy a home. Not because they can't access a mortgage, but because they can't find the home to buy because, again, 4,000 homes per million as opposed to 12,000 homes per million when we passed the CRA. So, Mr. Van Tol, Professor, and Mr. Mitchell, is this something we should explore?
Yeah, so the answer is yes, CRA can do something about that. Let me start by noting, we've done a study which found that 75% of redlined areas that were redlined in the 1930s are still economically distressed today. And so that remains an issue. The affordable housing supply problem is a huge problem. And certainly, CRA, for example, can motivate construction lending. That counts on a CRA exam. I think the problem is, again, going back to the local convenience and needs of communities, there's a real mismatch between where the supply is. We know of many communities in the Midwest where there are ample number of houses. It's just people can't get a loan, either because it's a very small loan size or the house needs too much rehab, et cetera, et cetera. And yet there are places like Washington, D.C., where you have a very hot housing market, where you have an incredible mismatch between the supply and the demand. We've actually started a bipartisan Affordable Home Ownership Council to deal and address with this issue because it is becoming an issue, especially in gentrifying areas where you have this incredible mismatch between the production of housing. Remember, the community development part of CRA does motivate institutions to invest in the development of affordable housing, including multifamily housing. And so again, if you were to remove or raise the limits or exempt certain institutions from that requirement, you're going to see less production of housing, not more.
Thank you. Professor.
Yes, and this is where the outcome-oriented goals are really important, like the stress test. So the CRA says it's not just about mortgages; it's about the convenience and needs of each community, and each community is different. Not all banks are the same, and so this is where you have to align. These are the needs of the community, and exactly as you said, affordable housing. Cities like Detroit are in hyper vacancies, where you can buy a house for $5,000, but no one's going to give you the financing. Where San Francisco, you can barely afford to get a house unless you're a billionaire. Okay, and so these are two different cities, and so those CRA requirements need to be matched to the convenience and needs of that area.
Mr. Mitchell.
To use your example of construction lending in say, a CRA community, it requires that the examiners, again, provide some clarity. If I'm going to lend to a construction lender who is wealthy and is going to build market rate housing, would that count even though it's in a low and moderate income community? I'm not sure. That's something that the examiner would have to determine. If they're going to build affordable housing, then yes, it would.
If I may interrupt, sir, and I apologize, I have so little time left, but I am particularly focused on starter homes or starter units because that's a place where I think the market has failed us. And the fewer starter homes that are available, the more people remain in a rental. The higher the occupancy rate, the higher the rents go. The higher the rents go, the more people become rent burdened. The more people become rent burdened, the more people need subsidy. The more people require subsidy, the more homeless there are. It's an ecosystem, and I'm totally convinced that we have to look at this in the context of it being an ecosystem. And again, I'm interested in how the CRA might be a means of helping, especially starter homes, workforce housing. My time is up. Thank you all so very much.
The gentleman's time has expired. I now recognize the gentlelady from Massachusetts, Ms. Presley, for 5 minutes.
Thank you, Mr. Chairman, for your leadership on this and so many other critically important issues. Representing the Massachusetts 7th, one of the most diverse and unequal districts in the country. In fact, a recent report by the Federal Reserve Bank of Boston found evidence of a widening wealth gap among families of color compared to their white counterparts. Across the city of Boston, close to 80% of white consumers own a home, compared to less than 1/5 across minority communities. Many of my colleagues have already touched on the civil rights origins of the CRA and the need to strengthen the bill to ensure that banks and other financial institutions are doing right by low-income communities. I fundamentally agree. It's one of the reasons why I'm so proud to have introduced the American Housing and Economic Mobility Act with Senator Warren and many of my colleagues, which would make housing more affordable and reverse decades of discriminatory policies that have denied Black and brown families. Our bill would also strengthen the CRA, extending it to non-bank mortgage companies, promoting greater investment in the communities that need it most, and strengthening penalties for institutions that fail to follow the rules. Mr. Odom, as you mentioned in your testimony, homeownership among Black families and other communities of color continues to lag at historic levels. How will strengthening the CRA lead to increased responsible mortgage lending and expand sustainable economic mobility for low-income communities of color? In the Massachusetts 7th, just in a 3-mile radius, Cambridge to Roxbury, median household income drops by $50,000. So how would strengthening the CRA address that?
Strengthening the CRA allows us to get the kind of data to track what's going on in the marketplace. The CRA is responsible for the data that we've seen presented by Mr. Glantz and his partner today. We would be totally in the dark if we didn't have the kind of CRA reporting requirements about where money is going and who is getting it. So I think from an informational standpoint, the CRA is critical in creating that type of transparency, that ability for lawmakers to at least see where the problems are and do something about it. Second, I'd say that it's important to strengthen the CRA because it's critical to the maintenance of our communities. We talked historically in my testimony about the fact that so many of the people who, in that 20% home ownership that you mentioned, African-American families, they're actually contributing to the depository institutions. Small businesses are putting their money in these institutions, and the money, at least historically, as what motivated the CRA, it flies elsewhere. It flies to the 80% of your district or home ownership that you mentioned. So it's important to keep this compact between local communities and local banks, because without them, you know, in my testimony, we talked about the high incidence of blight, unemployment, and lack of opportunity that results when you don't have access to capital. And third, I'll put in a plug for Black-owned businesses or minority businesses generally. Minority businesses tend to be underfunded compared to other groups, even in loans of last resort like SBA loans. I think the current data says that something like 3% of minority businesses have access to small business loans. By keeping a requirement in place in law, by keeping a light of accountability on this, we're hoping we can keep our communities intact and make them attractive, and when they are attractive, the capital will follow.
All right, very good. And Mr. Glantz, your investigations found some troubling evidence of the ongoing prevalence of, there you are, of redlining and discrimination in our banking system, trends you largely associate with the fact that the CRA, as currently drafted, is race neutral. Now, many states have moved forward with drafting their own proposals to combat racial discrimination by the financial institutions in their states by explicitly requiring them to track lending data by race and ethnicity. What are your thoughts on this approach, and do any other panelists have an opinion on the matter?
I would note that Massachusetts is one of the states that has its own Community Reinvestment Act law. However, when we look at the lending in the Boston-Cambridge MSAs, we found that among the communities' census tracts where there were at least 100 home mortgage loans, there were 320 of them, and all but 7 of them were majority white neighborhoods. And of those 7 neighborhoods that got more than 100 conventional home purchase loans in 2015 and 2016 in Boston and Cambridge, those 7 majority people of color neighborhoods, the majority of the loans from financial institutions went to whites. And that's what we found in our investigation.
Gentlelady's time has expired.
Thank you, Mr. Chair.
All time has expired. Without objection, I'd like to submit for the record a statement from me in regards to the OCC, statement from the BPI, testimony from the Bank Policy Institute, and a statement from the Credit Union National Association. I'd like to thank our witnesses. You were excellent. You were very informative. You've given us a lot to think about. And I would hope that the FDIC, the Fed, and the OCC has been listening to this hearing and will take into consideration all of your testimony and all of your thoughts as we drive and strive to have a CRA that is effective for all Americans. I thank my colleague, the ranking member, Mr. Lukemeyer, and my Republican colleagues, for indeed, as we talked, a broad range. We talk about urban America and the need for CRA to be appropriately applied in rural America. I think it will help make us all balance the playing field so that everyone can get an opportunity to enjoy the American dream and the right of home ownership and creating wealth. I end as I started. If it wasn't for my parents having the opportunity to buy a home and to have that home appreciate in assets, I would not have had the ability to pay for my college education nor my siblings. So this is a goal that I think that we all should have, because the better informed and as far as the opportunities are concerned, the better it is for all of us. And you have truly contributed a great deal to us by testifying this morning. So without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair and will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you are able. And without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing is now adjourned.